here live at MJ BizCon on day one with Travis Goad of Pelorus Equity Fund. Travis, thanks again for being with us on the Talking Hedge.
Thanks for having me on.
Appreciate it. Recap, what is Pelorus?
Pelorus is the longest running commercial real estate lender focused on the cannabis sector. We closed our first transaction in 2016 as a mortgage REIT, and we make loans, first lien senior secured loans on real estate and cannabis. We do construction and stabilized lending.
Okay. You were involved in a pretty big transaction, from my understanding. Can you tell us a little bit about the background on that deal?
Sure. So this is one that came direct to us. It's the TerraSend transaction. We funded a $46 million loan on their assets in New Jersey and Maryland. So this action came direct to us, not through a broker. It speaks to our relationships in the space and the deal flow that we see direct. And we couldn't be happier to have TerraSend and Jason Steve in the book. And we're very excited that we were able to enter two new markets. And so New Jersey is our first, and Maryland are our two first East Coast markets, where we've done some bids more on the West Coast and Midwest. So very excited to have that transaction done.
So let's unpack that a little bit, because I think $46 million is a ton of money to have direct, right? So normally that's not how it would work. Is it a scenario where it's not just about where you get the money? You know, we talk about smart money and dumb money. We don't want dumb money because there's no advantages to that. You want somebody that's going to be able to help you beyond just the capital injection. Is that the type of relationship that you're getting?
Yeah, so we try to help all of our sponsors out and share what knowledge we know of the market, and we're very much with our sponsors.
Where's the picture?
But yeah, this came direct to us, and one thing that differentiates us from some of the other lenders you may see in the space that have kind of launched recently is a lot of those guys will announce big transactions and they really broadly syndicate them to where they only actually put a little bit of money at risk, and then they syndicate it out to a bunch of different parties. We don't do that. When you come far from us, it all comes from our fund. It's 100% within our control, and that way we can control the process from start to finish and deliver on what we say we're going to do.
And this is collateral backed. Is that what kind of makes this transaction a little bit more straightforward?
Absolutely. So we have to be backed by real estate. So we do not do cash flow loans. If you do not own your real estate, you won't qualify for our program. But if you own your real estate, or you intend to own your real estate, as in you want a license, you identify the site, and you plan to acquire it, we can lend you up to 60, in some cases as high as 70% of the cost on a construction loan. And if it's already cash flowing and what we call stabilized, we can go up to 75%.
Now these aren't just sale-leaseback options, right? You have other investment vehicle options.
Well, to be clear, we're not a sale-leaseback. So sale-leaseback, you actually sell your real estate and agree to lease it back on a long-term lease. We're a lender, so what the advantages of this program is for borrowers is they maintain ownership of one of the most valuable assets in a new and emerging industry. So we actually just lend you money secured by your real estate, and so you can control it as the markets change. You have the ability to refi and do different things as well, and you don't lose control. So that's a big thing that we can offer our sponsors, which we feel is advantageous to sale-leaseback transactions.
Did the midterm election results in Missouri and Maryland speed up inquiries or demands recently, or is it just, are you just busy no matter what, or with these new emerging markets, do you find yourself even busier with people trying to find not only real estate but funding in general?
So we're really busy in this environment. Obviously, when you have S&P down 15 to 20% year-to-date, these cannabis stocks, which are less liquid, less investors can participate, they're off 50 to 60% year-to-date. So in this environment, they're all hesitant to issue equity. They prefer not to do it. They really shift to debt if they can get it. And so we have a tremendous pipeline in front of us right now. There's a tremendous demand for capital in the space. Maryland and Missouri literally just flipped in this election as far as going direct. And so we do expect to see an uptick in demand tied to that. We haven't seen inbounds quite yet on it, but we do look at deals in both markets.
Is it interest rate sensitive? Does that even matter?
Interest rate sensitive interest rates matter, right? Anything when treasuries are at 4%. everything else prices as a basis to treasury. So yes, interest rates fundamentally matter for any credit lender or taker of borrower credit. What we've shifted to is a floating rate loan model, and so you have to in this environment, right? And so we price on a spread of 1 month SOFR, which is a secured overnight funding rate, and so it kind of moves in line with when the Fed raises rates. Our investors benefit from that, but it's what you have to do in this environment to be able to continue to raise capital.
Are you finding more people exiting private equity and even the public markets in favor of more solid returns?
Yeah, we're seeing that, yes. I mean, right now, I think everybody's trying to get their bearings as to when are we going into a recession? What does that look like? How far is the Fed going to go? There's just a lot of open questions. So I think what you see generally in capital markets is just things are kind of like slowing as everybody just takes a view of what's happening in the world and what this may actually go to. But we are seeing that investors generally want to be in private credit instruments because you've been able to get a lot of that liquidity premium, and you get to, we're out there negotiating these loans, structuring these loans directly, and it results in above market returns to investors, and it doesn't have the volatility and mark-to-market risk that you're seeing in other instruments. And so that's why we could have gone public a couple of years ago. We got the same calls from bankers that a few of our competitors got. Our competitors chose to go public, and frankly, it's been hurting them year to date because they're public. They've been trading below book value, and they've been unable to issue new shares to grow their book. And so we've still enjoyed inflows all year, and that's why we're one of the few lenders that actually have capital to deploy in today's environment.
Yeah, there's a lot. I was speaking to Side Asset Management, Morgan, and he's got a publicly traded ETF, and it's highly, we'll say, valued because they're getting lumped into everyone else. Cannabis stocks tend to move with the news and not really moving independently, but you don't have to deal with any of that.
Correct. No, I mean, it affects our borrowers and sponsors as to where their stock, if they're public. A lot of our borrowers are also private too, so we'll limit both public and private. So we have one of the benefits of being private is that you don't have this, volatility that kind of impacts when your core business is doing well. Then becomes really noise that impacts and becomes distracting, and we don't have to deal with that.
What are you doing on the due diligence side, the risk management side? We just saw, I was going to say XRP, what's the Sam Bankman-Fried crypto, XTF?
FTX.
So a lot of people did their due diligence based on other people's due diligence,
yes,
right? Which meant no due diligence. What are you guys doing in order to ensure that the applications are correct and accurate and everything is above?
Yeah, so we spend a tremendous amount of time. We were one of the only institutional lenders in the space, and so we have a very much institutional lending process that comes from, I spent my career on the institutional side of real estate, worked on large private equity companies, worked in a hedge fund, did a lot of stuff in the real estate credit space. And basically, we brought over legal teams that did not specialize in cannabis, typically some of the highest end real estate transactions in the country, and convinced them to come over and represent us in the cannabis sector. And so and the team we've built out in New York all come from institutional, large banks in New York that are doing things in an institutional rigor, and so we've taken those processes and adopted them to our company, and we do everything as though the highest end real estate people in the country are doing. So we have a formal due diligence on the legal side. We go through the financials, we verify everything, we tie out licenses, we do all of that stuff that an investor should expect their investment manager to do.
Okay. Is there any places or sectors, whether it's a production facility or manufacturing or grow or a region, that just you just want to stay away from?
So we'll look at any legal market. It's hard to just fully redline things and say, I won't do it. You hear some people say, hey, California is troubled. You shouldn't be in the California market. California is the largest legal cannabis market on the planet. And if you're a cannabis-focused lender and you can't figure out how to lend in that market successfully, then you probably shouldn't be in the space. So we will look at markets. There are some markets that do, given certain dynamics, give us pause, and some markets we really find value to vertically integrated. I would say right now in Massachusetts is a prime example, where if you don't own your own retail, there's an oversupply right now of wholesale flower, and so we wouldn't look at a deal right now in Massachusetts until it's very vertically integrated. So there are certain things like that that kind of pop up from time to time, but we typically see periods of kind of oversupply, and then it goes into undersupply, and the market will eventually correct itself. And so we don't redline any market. We're very in tune with the dynamics of what it takes to be successful in these markets, and we target that.
Do you have a shorter process for individuals that have done it before, if the management has experience and/or it's been on the West Coast for a while? Is there a faster process, or is it all the same no matter who's doing it, when and where and how?
So we do due diligence on the operator and what they're doing. It's not necessarily a faster process. We do a full dive on everybody. We wouldn't lend to anybody that's never done cannabis. So often what we see is in a market where there are well-connected business people that have licenses in these markets that may not have a cannabis background, but they should always partner with to bring in cannabis. Otherwise, we wouldn't even do the transaction. We're not going to let. We wouldn't take the kind of risk of a first-time grower just kind of figuring it out. So we require a build team in place, build processes in place, and to qualify for lending program, we don't give you 100% of the cost of the facility, so you still have an equity check. So you also have to have a management team strong enough to attract equity, which is hard in this environment. So there's a couple of different layers that we look at.
So if it's a scenario medical in Arkansas, you wouldn't do that, or even if it's Missouri, that just if somebody doesn't have the experience, you're not going to touch it.
Correct. Now, we would look at, just so we're clear, we'll look at deals in both of those markets. We've done deals in Missouri. We like the Missouri market. But we wouldn't do it if you've never done cannabis before. There has to be a partner, and a team, an employee base that has substantial experience executing on this for us to ultimately lend to. So that's what we typically see in these new markets, and it's back to that. Example I gave about the business, well-connected business people that often win these licenses, they've been doing other businesses in these states for years, but they always bring in or partner with a cannabis operator or grower who's run a team before, and that's how we get it comfortable. But if it was just one without, we wouldn't touch the deal.
Is there a best performing sector if you had to say, oh, retail is better than manufacturing or the grow? And obviously I'm trying to differentiate between fully vertically integrated into each segment. Is there any one that you see that outperforms?
So it varies so much by market. I mean, this is one of the most regulatory-driven industries that's emerged in a long time. And so, in Florida, for instance, it's all you have to be vertically integrated. Everybody that touches the land has to be your employee. They allow a lot of different dispensaries, et cetera. So it's just a different model. And then in California, for example, a lot of people did go vertical. They went down the model, and now we're starting to see a little bit of disaggregation in the supply chain. Some people are launching co-packaging businesses and other businesses that kind of specialize, which is typically what we see in other industries. We generally see vertical integration is a big positive in this market. Cannabis changes so quickly that everybody wanted to be in retail, and everybody wanted to be in cultivation, kind of go back to where this would be. Today, what we're seeing, especially in a market where there are periods of oversupply, where there's price compression on flower and product, having a retail footprint where you can control your own shelf space and you can insulate some of your margin compression is incredibly valuable. And so we really look to that model in most of these states. Pure wholesale models are the first ones to really take it hard when you have periods of supply. And again, as this market develops and grows, we're constantly learning from what we've done and watching what our borrowers are doing and how things are performing, and get a sense of, hey, what do we want to do the right way next time? What do we want to do? What do we do right here? What do we do better?
What's the liquidity within your portfolio if shit hits the fan in terms of systemic risk, if there's strategic defaults and a collapse in commercial housing and the economy just completely tanks? How easy or quickly can you get out of these investments?
So these are if we go into the recessionary environment you're describing, we think it's good to have exposure to the sector because it's a high growth sector. It's a more mature industry. Right. Here there's a lot more growth. So it's about a $25 billion a year sales industry today. And it's projected to go to about $45 billion over the next 5 years. So in a recessionary environment, we expect to kind of outperform, similar to alcohol, where maybe the quality of product you're buying may go down, but consumption probably goes up because in stressful times, that's what people want. And so we do, and we're starting to see some dynamics play out like that. And two, in cannabis, there are not many investors that can take advantage of it on the institutional level yet. We're starting to talk to some, and some are looking at coming into the fund, but it's been primarily retail investors up until this point. And so there's not a lot of liquidity in the space generally, and since we're one of the few lenders, we would never want to be a forced seller of assets in a down market. And so our fund liquidity, there's a 6-month lockup, and then investors can basically take out 1/12 of their investment over a 12-month period. And then there's a separate fund level overlay where the fund it's modeled up REIT's fund structure. So you're familiar with that, Blackstone's REIT, but you can't take any more than 2% of the fund out in any 1 month, 5% in any quarter, 20% of the fund in any given year. And so that's how we protect ourselves from the situation, because these are at their core, and that's part of the reason we're returning 15% every year since full operation is seeing that risk premium, the liquidity premium, and investors need to recognize that and understand that.
Yeah. Well, you're not supposed to be flipping real estate like that anyways,
correct.
In theory. That's awesome. There's going to be some institutional investors probably coming in, so I definitely want to follow up with you on that. Anything else you want to cover?
It's a fast-growing space. We're happy to be involved in it. We just closed another transaction. I would like to touch on that too. Is we just wrote one to Cannabis Valley Farms, Michigan, $16 million loan. They're doing some pretty interesting things with partnering with genetics, doing high-quality extracts and other things in the Michigan market. And so we're still putting out capital. We're still finding opportunities. We're finding people that are differentiating themselves in the sector and deploying where other people in the sector may tell you they have capital and they don't really. And so I just want to put out that we're still a lender with throughout cycles. We have to adjust as the economy adjusts, but we're here to deploy capital and support the space.
Yeah, I think your reputation speaks for itself too. If anybody knows anything, they'll figure it out. But with that, I think we're going to have to roll this one up. So I want to thank my guest, Travis Goad. He's with Pelorus Equity Fund. Travis, thanks again for being on the Talking Hedge.
Thanks for having me.
Appreciate it. I'm Josh Kincaid. This is the Talking Hedge. Don't forget to like, share, and subscribe, or don't. And I'm out.